Good morning. Today we have Stephen Barrett joining us to share his experience in trading in volatile market. Steve has 25 years experience trading in investment bank hedge funds. Good morning, Steve. How are you today?
I'm good, thank you.
All right, good. So market dropped 30% the last few weeks, and we are in the so-called panic mode. In this environment, what is your advantage as investment professional over retail investors?
I think I've got a number of advantages. As a professional fund manager, I can trade a number of different instruments rather than just equities, and I can trade a number of different geographies as well. So, for example, if there's a crash happens overnight in the US and I'm trading Hong Kong, I can be on the phone to my broker at 5 o'clock in the morning looking for Japanese, Australian trades, hedges, or even overnight US futures, so that I can hopefully put my hedges on before Hong Kong guys are getting up and getting dressed.
Good. So given we have two black swans events come together, COVID-19 oil price shocks, the outlook of this year must have changed significantly since December 2019. What process do you and your team go through in this stage to re-strategize your portfolio to cope with these changes?
Okay, well, first thing I'd look to do is manage my portfolio exposure risks as quickly as possible in a new environment, a new risk environment. So get my hedges on quickly and rebalance my portfolio so that any dislocations that the crash has caused are evened out. Then I've got my portfolio in an understandable and solid footing. Then it gives me time to employ my team of analysts and my network of bankers to look for the opportunities that the volatility presents, because once I've managed the risks of volatility, I can then look for the opportunities in the volatility.
Good. So the last few weeks we heard lots of sensational headlines like meltdowns, recessions. Do these headlines affect you in the trading room? Are these headlines have any values to you?
Okay, well, first thing to say is that I don't think any fund manager would ever have Squawk Box TV on their trading floor screaming, sell, 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 panic, panic, panic. I think the first thing to do is avoid panic, and experience helps you to do that. But what you have to do is stick to the facts. By panicking, what you might do is you might lose sight of your investment goals, and you then might depart from your action plan. And that then potentially could lead you to do something that you really regret. For example, selling at the bottom and not buying back in and missing a bounce. So I think you have to have a clear head and avoid the panic.
Okay, so if we're really going into recessions, are there any differences in your trading strategies, tactics, techniques at the lower level comparing to the bull market?
Look, in the later stages of the recent bull market, certainly in the last year, people have been running out of reasons to explain why the market's been so strong. And I think that anyone that's been participating has done so kind of while holding their nose. They've done it because they don't want to underperform, but they can't explain why they're doing it, and so everybody feels a little bit dirty for doing it. They're like, "Oh, I shouldn't be doing this. I don't trust myself." But I think that this additional level of volatility, it gives certainly, I think, the professional fund managers, it gives them the opportunity to exploit their skills and their experience in order to outperform the broader market. They have a team of analysts who they trust, who know their stocks and sectors inside out, and you have opportunities to buy really good stocks at really good prices.
So what kind of sectors that you would be looking at?
Well, I'd be looking at I'd be looking at the style of the stocks. So I'd be looking at defensive stocks, consumer staple stocks. Look at what Warren Buffett would buy, for example. Like Coca-Cola. People are still going to buy Coca-Cola, right? Tobacco, toothpaste, soap, that kind of thing. Supermarkets. Everybody still needs their groceries. And I think that the key thing really is you've got an opportunity to look for cheap and well-priced stocks in companies that have got strong cash flows, that pay good dividends, that are well funded, and very robust. You know, they might be in a bull market they would be called boring. In a bear market they're called treasure. You know.
Okay. So, am I right to say that as an investment professional, you guys are well positioned to generate values for your customers through good times and bad times?
Well, certainly, I have to justify my performance fees. So, you know, what I would say is that a fund manager will, at every given point in time, will be running through scenarios regarding what might happen going forward, whether it be markets going up, markets going down, markets crashing, markets doing nothing. Each one of these scenarios will be factored in, will be gone through by the whole analyst team, and as and when that event happens, we have a strategy for that. We have we go to that part of our action plan, and we don't have to think about it as the event is happening. We've already pre-planned for it, so we have our playbook ready.
Okay, great. So, lastly, what is your advice to the retail investor at this moment?
Well, I'd say stay calm, try not to panic. I know it's tough when you see your portfolio leaking money, but manage your risks, understand your risks. Don't lose sight of your investment goals, and don't lose sight of your action plan that you put in place to achieve those goals. If it makes you feel better, which it probably will, talk to your advisor to make sure that your action plan will still get you to those goals. There's, you know, you could say that there's opportunities to improve your action plan, but talk to your advisor, stick to your goals, stick to your plan, and don't panic.
Good. Thank you very much, and thank you, Steve.
You know.